Welcome to The Mind of Money. My name is Douglas Lodmell, and today my guest is Bob Prechter. Bob is author of Conquer the Crash, as well as the Elliott Wave Principle. And Bob, thanks for joining me.
Yeah, I'm glad you took the time to come and see me.
Yeah, it's a pleasure. So I wanted to really start off with, I follow your work. I think it's fantastic. It's very enlightening, and it helps me really in a very practical way. But many of the viewers are going to be unfamiliar. So if you could give an elevator summary of how you see the world and what your work really is, that would be a great place to start.
Yeah, the work we do is so different from what other people do that sometimes it can feel foreign to people. Most people look at news and events and so-called fundamentals to decide where markets are going. I actually think those are not causes, they're actually results.
Yeah.
That markets are buffeted by waves of social mood.
Yeah.
That those changes in social mood are endogenously regulated. And what that means is it arises naturally from human interaction.
Yeah.
People become more optimistic for a period of time. They become more pessimistic for a period of time. And we track this according to a model called the Elliott Wave Principle, which is a model of fractal movement. 5 waves in one direction, 3 against the trend.
Yeah.
Again and again. And those iterate to larger and larger patterns, all looking roughly the same. 5 waves in one direction, 3 against the trend.
Yeah.
Nothing is always crystal clear, and nobody has that perfect knowledge of the future. But I think people using the fundamentals are mostly lost because the fundamentals lag what the market is actually doing.
Yeah.
What we're trying to do is track the market in real time, and if you can track it while you're utilizing this wave model, you can often anticipate important turns and even describe in advance the kind of change you will see not only in the market, but also in society in general. And we're seeing some pretty dramatic changes there today, and those are the kinds of things we try to anticipate.
Well, let's go back because you have some history. So let's put some history to this.
That can sound 2 different ways. You have some history.
Well, you wrote the Elliott Wave Principle in 1978.
Yeah,
so you did make some predictions in there. So we do have a little bit of a track record. So in 78...
there's a track record of Elliott Wave practitioners going back to 1934.
Really?
Mm-hmm.
Okay, so when you picked this up and you wrote that in 1978, what did you see for the world then?
Well, my co-author and I, A.J. Frost, who now is deceased, decided we wanted to write a manual about the Elliott Wave model, how to apply it, and so on. And when doing so, you can't help but explain where you are in the current juncture, because when you're labeling the progress of these waves in a model,
you have to start somewhere.
You start somewhere, and you have to be somewhere when you discuss it. Well, what we call the orthodox top, the true peak, in the great bull market from 1942 ended in 1966, and from that point forward, we had been in a bear market. We were writing the book in 1978. The Dow was around 800 when the book came out, and we said this is a 4th wave in our model. That means there's one great big bull market ahead. Very much like the 1920s, and in fact we said this is going to be much like the roaring 20s. Little did we know it would dwarf the roaring 20s by 3 times. But we were predicting crazy numbers like Dow 4000, the time when it was at 800, and people thought, these people are out of their minds. And then later on they said, well, you weren't bullish enough. But we did call for mania in stocks and institutional mania. Individuals would go crazy. There would be new vehicles that people could trade, and of course that's gone.
The innovation of the derivatives market and all of that
again
came out
to
of
lengths
the mania.
we never even imagined. But we knew that was going to be the direction. But we also said something very important. We said when that big bull market is over, the next bear market, since that is the 5th wave and that ends a 5-wave structure, you're going to get a big 3-wave move in the opposite direction. That we'd have the biggest bear market since at least 1929, 1932.
Okay, and in your model, that starts when?
Oh, it's already started. In fact, in real terms, it started in 1999. That's when the averages peaked in real terms. And they peaked in terms of the producer price index, in terms of gold, which is real money, in terms of commodities. The Dow and the S&P all peaked in 1999 or in early 2000, depending on which measure you're looking at. Now, in nominal terms, because so much money, fiat money, was created between 2000 and 2008, the nominal averages managed to make a new high in 2007.
Right.
In fact, a few of them, which are bullishly biased, made a new high in 2011,
Yeah.
such as the value line arithmetic index,
Yeah.
which that's amazing. But it's mostly due to the fact that the measuring unit has shrunk.
Yeah.
And so it's really phony gains in that sense.
Well,
real money has had the bull market.
Okay, so let's talk a little bit about that phony money and what the distinction is, because there's really, the way I understand it, there's two types of money out there. There's the fiat money that we create, the dollars we print, and even the quantitative easing money that we digitally print. And then there's money that's created through the credit system. In other words, I'll call it credit fiat money. And that's when the bank, through fractional reserve lending, creates money by lending it into existence. And one of those is collapsing right now, and it's actually going to send the other one become more valuable. Credit fiat money is collapsing. Am I fair in saying that? While fiat money is actually going to end up becoming, the most desirable thing.
Yes, I think I'd like to start. I'd like to start with the fundamental idea that there's only one true money.
Okay.
And that is money that holds its value over eons of time.
Okay.
That people naturally treat as money, that is not only a medium of exchange but a store of value.
Okay.
And the best item that's been used for that over the ages is gold.
Yeah.
Now, what the country decided to do back in 1933 was to go off the gold standard.
Mm-hmm.
And we entered this new world, the one
Right.
you just described, fiat money.
The fiat money, which replaced the gold, the pure
Right,
fiat
by
money.
law.
By law, yeah.
It wouldn't have replaced gold because
Uh-huh.
people always go to the better product when they have a free market.
Uh-huh.
But the government outlawed gold as money and
Mhm.
said, you're going to have to take our fiat money
Mhm.
instead. Now, it's interesting to me that there is no such thing as money in the fiat money system. We use the term money just as a shortcut,
Mhm.
but there's no money there at all. In fact, the money that you were just referring to, the notes that the Fed prints and
Yeah.
the credits that they offer to the banks, are actually backed by what? Debt.
Debt, yeah.
Long-term debt of the United States government.
Mm-hmm.
And some other debts as well that they've
Mhm.
recently taken on, but mostly treasury bonds.
Right.
So really it's debt backing what they issue. It's called a note,
Yeah.
which is supposed to be another IOU, although
Right.
they don't give you
That's the
anything
word
for
we
it.
use when we draft a
Yes.
note for somebody. It's a
Exactly.
credit instrument.
Right. So fiat money is truly all credit based.
Yeah.
However, once someone with his hand on the printing press actually issues a note that's irredeemable in anything else,
Right.
that's what we have to term money in
At this
in
point, that's
system,
our base money.
in this system.
Yeah.
And that can be created pretty much at will. And people
Mm.
often bring up Zimbabwe or
Mhm.
different countries in South America or Germany in the early 20s that had hyperinflation because someone cranked out the notes
Yeah.
off a machine.
Yeah.
But our situation is very different, and this is what prompted me to write Conquer the Crash back in 2002.
Right.
And that is that a small amount of that kind of bank note money
Yeah.
was underlying a tremendous inverted pyramid of debt.
Right.
IOUs of all types.
Yeah.
You had as little as $500 billion, I think it might have been 800 billion when I wrote the book, of fiat dollars.
Credit coins and cash.
Yes.
Yeah.
Supporting all of the IOUs, which then amounted to $50 trillion and
Right.
now amounts to over $70 trillion. And that's if you're very conservative
Right.
in counting how much it is. So
Right.
for two reasons I wrote the book. Number one, the five-wave structure under the Elliott wave model was coming to an end on
Yeah.
a very long-term basis, telling us that social mood was peaking and therefore was about to get more negative, and this had all kinds of consequences. And the second one was the, if you want to call it a fundamental aspect, which had built up because of all the positive social mood, which is
Yeah.
all the credit that the creditors
Right.
believed they would get back because of their optimism,
Yeah.
and the debtors believed they could pay off because of their optimism. There's too much of it, it's unpayable, and that's a perfect storm when you're going to have a change to the downside in social mood with an extremely risky set of fundamentals.
Well, I understand that, and what I hear all the time from my clients is, okay, I kind of get what you're saying, but it can't possibly happen. It just can't. I mean, it's just in my bones. We're the United States. This is 2011. Just can't. We can't go into something like that. I just don't see it. Somehow they'll solve it. They'll figure it out.
You're right. That permeates a lot of people's thinking, and I don't know what to say, because if you study history, you know that the history of social man is one of extreme cycles.
Yes.
Not just moderate cycles, but extreme cycles.
Yeah.
One of the analogies I have today is that I think 2007 is somewhat like 1937.
Yeah.
People were dancing to Benny Goodman and having a ball, and it wasn't but a few years later that World War II started.
Yeah.
And the world was so different 3, 4, 5 years later that it's just stunning. Now, if you can't see around the corner, you can't see things like that happening. But with the wave model, you can often see around those corners, as we did in 1978.
Yeah, well, and it again, I'm coming from a standpoint where my mandate as a professional has been an asset protection attorney to protect from an unlikely but potentially devastating event. That's what a lawsuit really is. And today I see that set up in the market. I can't say how likely it is, but the more I understand, the more likely I assign that possibility, and the effect is potentially devastating.
Well, the word unlikely is an interesting word.
Yeah.
I think that it's applicable statistically.
Yeah.
If you talk to a statistician, he would say, oh, it's highly unlikely.
Right, right.
Okay? But if you talk to a historian or someone with a model such as ours, which is a model of change, not the kind the economists use where they linearly extrapolate everything. Ours is an extrapolation of a fractal model saying, look, change is coming. The only question is how big it is. I went out so far out on a limb in that book that I said, I'm a one-armed economist. I don't see any other outcome than the one I'm describing here. Yeah. So it went from unlikely
to certain.
To virtually certain. I mean, you know, I would go as far as to say we all know exactly what the future will bring, but as close to certain as I believe I can get, and therefore, what's the downside from being safe?
Right.
You know, I always ask people, you know, back in 1982 when we were saying you want to load up on stocks, we were kind of nervous because if we were wrong, and there were people predicting 400 on the Dow and 500, people would get hurt. But this time I said, you know, I can't hurt anybody by advocating safety, and I know that's what you do as well.
Well, that's really my whole message, is that if you're not sure, let's just say that you assign a 50-50 chance to it, or an 80-20 chance, it doesn't really matter. But what's the downside of getting safer than what you already are now?
Well, some people will say, well, I don't want to be too safe, because a lot of the things that people who advocate safety recommend don't have enough yield for me. I want yield. Or, you know, I don't have enough excitement. I want to be in some markets that are moving. Yeah. Well, my answer to that is
go to Vegas.
The second half. Well, you could go to Vegas, but if you in the second half, you can take a small percentage of your money. And if I were speculating, I would speculate on the downside.
Sure.
You can use the futures market to make a lot of money on the downside as well as the upside.
Right, and appropriately hedge it. Really, if you have you know, most of your money safe, then it's a fair bet.
If you have most of your money safe, then it's okay, and your emotions won't be too wrapped up if most of your money is safe as well. Right. But back to the first part, the yield part. There's an old adage: it's nice to get a return on your money, but you need to make sure you get a return of your money. And I think we're entering a time when that risk is going to skyrocket. Yeah. Just like people found out who bought subprime mortgages back in 2008.
Right, which I see they're coming back around again. We're going to have a second round of subprime
Isn't
crisis.
Isn't it incredible? I mean, you know, the shot across the bow, and people say, you know, I'm going to get a chair and go get some sun. Yeah. You know, I just, it's really something. This partial recovery. And when the market bottomed in March of 2009, we came out at that time. There were only 2% bulls recorded by the daily futures tally that tradefutures.com keeps. And that's when we stepped up and we said, we're at a bottom. It's a clear 5 waves down. We're going to have a 3-wave counter trend move. It's only a bear market rally. It's not going to go to a new high. You need to get out of the way. And we even said in April of 2009, okay, this is just a few weeks after the bottom, that when the top came, no one would believe it was going down. Right. Everyone would have adopted the bull market idea. They would say the Fed rescued the monetary system, the government's programs worked, the economy's in recovery. We said, we also said, and the president would get more popular, which he finally did right around March, April, May. It was his peak in popularity when the market topped out. And all those are all effects of positive social mood. Well, we've turned down since then, and I think we have entered a wave down that's going to be larger than the 2007 through 2009 decline. So you need to, you should be as safe as possible in this environment.
So in your model right now, the highs that we just saw, that's it. We've seen the last of those.
Yes, and we can talk about some of the market analysis that I think goes along with that. If the people you you speak to, are interested in the technical aspects of things, but that is our conclusion. Yeah.
Well, you did an incredible video in your last Theorist, which is a video version of it. And if, I mean, that's where I would point people to because it was an incredible analysis, and you really explained it in a way that was just unavoidable to draw the conclusion. The parallels are too
Well, I think
accurate.
it's unavoidable, but the vast majority of people, there are two camps out there.
Yeah.
And I find this fascinating. There's the recovery camp,
Yeah.
and they all bet on the economy's going to boom. It's a normal, time in history. We just came out of a recession. Everything's going to be great.
Yeah.
And some of the people who run funds, very famous people, are down as much as 50% just this year who've adopted that view. Okay.
Yeah.
Now, the other camp, which you would think I would be in, but I'm not, are the bears who say the outcome is going to be hyperinflation.
Right.
So you want to own commodities and metals and land and so on. Well, real estate just made a new low for the entire decline in 2006. Silver's already seen its high, and it's down more than, I think, up 47% at the recent low. Yeah. Commodities made their high 3 years ago in 2008. They had a recovery rally, a perfect 62% retracement. Yeah. Which is one of the percentage retracements that we pay very close attention to. The only thing that held up is gold, and that's what's keeping them, believing in this. Mm-hmm. It's to me somewhat of a fooler, because they'll hold on to that last bull market until it finally rolls over as well.
Why? I mean, it's
because people always focus on whatever the last thing going up is and whatever's going up the most. You remember how much everyone loved oil back when it was going up? It finally hit $147.50 a barrel. I mean, it was the craziest overvaluation in the history of oil. Everybody believed in peak oil were going to run out. Back in 2000, they believed that technology was so amazing that they should own NASDAQ stocks at hundreds of times earnings, thousands of times earnings, and usually with no earnings. Yeah. So there's always a fundamental story, and of course the fundamental story behind gold right now is hyperinflation, and we'll never get out of it. I do want to say one thing. As I said at the very outset of our discussion, gold is the only real money. Yeah. There are some other experiments coming out which I find very interesting on digital money. Yeah. But for now, the only real money is gold. So.
Which doesn't necessarily mean gold is going to 5,000.
No, because we're stuck in this fiat money system that you talked about right at the outset. This means all of the debts that we talked about are denominated in what? They're not denominated in gold anymore.
No, dollars.
We used to have contracts denominated in gold
up
until 1934, and then Roosevelt said you can't do that anymore. So they're all denominated in dollars. That means to pay back the debts, people have to come up with what?
Dollars. You have to convert your gold into dollars.
And this is another stance we've had for quite a while. We're very bullish on the U.S. dollar, not because we think things are going to be great, but because we think that the debt is going to implode and people are going to be demanding whatever dollars remain to pay off those debts.
Right. Well, that's a very important understanding, because this distinction really makes a difference. You can see gold as real money and still understand that it's not going to be 5,000. It'll still buy as many barrels of oil, though.
Yeah, or a good suit, as they say. Yeah. It's been able to buy that for 1,000 years.
An ounce of gold will always buy you one good suit.
Yeah, exactly. Yeah. And so that's real money, and that's what it means. It doesn't fluctuate per se. What's really fluctuating is the value of the fiat money, up and down. Right. And it has lost a lot of value in terms of real money since 1999, 2001. But I think that's about to change because of the debt implosion that's beginning to reignite.
And as this debt, so we have, if I can picture this, we have this credit fiat money, which is just the debt, which is just top of this inverted pyramid. We have the fiat money, and then we have gold over here that's not allowed to really play in the game, but that is representing, at this point, the fiat money. So as this pyramid collapses from the top down, the fiat money that is left is going to become incredibly valuable.
Exactly. Now, this little bit at the bottom that you're talking about, those are the dollars that have been created.
Printed,
basically
$100 bills.
Right. But those are what all of the debtors owe.
That's right.
Now, if they owe 70 trillion, be conservative, you can make a case it's in the hundreds of trillions of dollars. Yeah. And suddenly the creditors decide they want them. Yeah. There aren't enough to serve it. And a lot of people say, oh, the Fed's just going to print, and they'll never stop printing money. In my view, this is a myopic view of what the Fed actually does. The Fed actually takes on what they believe to be pristine assets, again, IOUs, that's all debt, and then they issue notes off of that collateral. At some point, I believe the Fed, I've been saying all along, the Fed is going to stop for two reasons. Number one, they're going to be worried about the value of that underlying collateral. They took some tremendous risks in 2008 when they bought mortgages and such. They own a lot of Fannie and Freddie paper, but they got the government to guarantee it. So it's almost as if they own a T-bond. They're really sticking pretty much to the safest debt you can get. I mean, they're following your advice. But I think the other reason, and this is what I've been saying all along as well, the change in social mood is going to bring in monetary conservatism, and politics is going to basically make them stop. And you saw what happened.
It's happening right in front of our eyes.
Right in front of our eyes. There was no QE3 suddenly
announced.
That's right. There may be one down the road if there's a lot of pressure, but right now the Fed has internal dissension. It's got external criticism. And again, I think they're looking, some of the people inside the Fed are looking at their portfolio and saying, some of this, we don't want to own a lot of really junky stuff. It will ruin the Federal Reserve Bank. So they're stuck. They've created too much debt through the system, and now the debt has to be repudiated.
Well, let's talk a little bit about the average guy now. So somebody that is a client of mine, or who's watching this video, and they have a little bit of money.
A client of yours isn't exactly an average guy.
Well, maybe not the average guy, but definitely the average millionaire next door. Let's call it. They have a little bit of money. It's $1 million or $2 million.
A true saver investor.
They've saved. They've worked very hard for this money. This is not somebody who it was given to. They didn't start with it in most cases. And it's what they've got. They've got it, and they need to retire on it. It needs to be there for them. And they already think I'm in the safest thing. And so they go out and they put it in cash. They put it in municipal bonds to a large extent. And they'll put it into conservative growth stock portfolio managed by a mutual fund or something of that nature. What would you say to them, that person?
Well, I would say that you're not in cash.
Okay.
That every single thing you own is an obligation.
Yeah.
Every single thing. If you think you're in cash in the bank, guess what? If you know the law and if you read the prospectuses of banks, they are not keeping your money safe. They're not safe keeping your money.
No. They owe you what's in your account.
Exactly. You lent them the money. So your bank balance is nothing but an IOU. If you own stocks, that's very nice. You have a portion of the company, and that's sort of a tangible thing. However, what they also are saying is, we owe you a lot of dividends. And someday they might not be able to pay those dividends. When you talk about municipal bonds or any other type of bonds, those are obviously IOUs right off the bat. They say, we will pay you those dollars, we promise. So to actually get into a really safe liquid position is not an easy thing for most people to do. That's why I had to write half a book to explain how to do it.
So the answer is that you think you're being safe right now, but you're not, because those assets, even the cash in the bank, may not be accessible to you. When we have this deleveraging, when this credit money system collapses on top of that fiat money system, what you're going to be able to get to is the $100 bills, the $20 bills that you have buried in your backyard.
Most people just have a few in their wallet.
Right, and that most people don't even bother to keep any extra, but whatever you have is what you're going to have. So you won't be able to go to the ATM and get them, is what it possibly.
Yeah, I think that's an eventual result of the problem.
Okay. But whatever's in that bank account may not be as accessible as you think it is.
Think about this. What is backing the deposits that you have at the bank? When they give you, when you look at your bank book and you say, oh, I'm fine, I've got X dollars in the bank. What is backing those? If you go in the bank and open the vault, what are you going to find?
A bunch of air.
A box of mortgages.
Exactly.
Well, that's okay in good times. Mortgages keep their value. But as we've seen lately, and I'm pretty surprised that people haven't gotten worried about banks in the United States yet, the value of mortgages has fallen dramatically. And the value of housing is falling dramatically, and that's the collateral that's backing the mortgage.
That's right.
Which is the collateral backing your deposit at the bank. So, in my view, this is becoming more and more of a dangerous situation. So, nobody following me is taking those kinds of risks. We've already determined ways to pretty much avoid that kind of banking risk.
Well, and what I tell my clients is exactly that. It's the money that you think you have in the bank is not really as safe as you think it is. The municipal bonds, even though, let's say you bought the top grade, the highest 1% of the value, the grading of those, it doesn't mean that they're exempt from what's occurring here, because this is global, right? I mean, this is systemic. This is not an individual isolated thing that's going to be able to withstand.
That's correct. But some people, such as you, that knows the bond market really well, some specialists.
Yeah.
I know a few other people who are really good at picking the safest imaginable bonds.
Yeah.
There's probably an edge there.
Yeah.
Certainly, if there's an implosion systemically and a lot of debt goes under, some will probably survive.
Yeah.
But I'm not smart enough to pick those out. And in Conquer the Crash, I said, look, I don't know which IOUs will be AAA at the start of the Depression and remain AAA throughout the entire Depression.
Right.
And that was true of U.S. government bonds back in the 30s.
Yeah.
So you could say at the end, that's a great thing to own right through the Depression.
Mm-hmm.
But I said at the time, I can't even say for sure that U.S. T-bonds will remain AAA.
Yeah.
And at least one outfit has downgraded them from AAA already.
Yeah, right.
So you can see the kinds of stresses that are already occurring in the system. And my answer is, I don't think you can regret being too safe.
Right. What's the risk? What's the downside? So
a little bit of interest.
Yeah, a little bit of interest. Which, if you're in munis, 4% of tax-free interest. So what?
Yeah, if you're a fairly wealthy person to start with, you shouldn't risk that, in my view.
Right.
Or if you are risking it, you should pick the point at which it's comfortable to get out. Most people, when they finally make up their minds, prices are down 20 or 25%, and they take a loss.
Right.
And then the ones who say, I don't want to take a loss, that's the flip side of I need my interest, may stick in there. Maybe they get lucky and they can clip their coupons right to the end, or maybe they get unlucky and they own bonds from a municipality that goes under.
Yeah.
Fulton County down in Atlanta was formed from two bankrupt counties in the 1930s.
Right. Yeah, and this is the big thing again, and I love the what you're saying about how what the Elliott wave does is forecast based on how people react. So you're really looking at the people and the system of how we interact with each other, which doesn't really change or hasn't really changed a lot. It's evolved, and we do it differently, and we do it with different technology, which actually just speeds it up and makes it bigger. But I don't see how it's going to be different this time.
Well, the reigning paradigm for many, many years has been and still is the efficient market hypothesis, which does not really include anything about emotional human nature at all.
Right.
It's we're all 100% rational. Stocks are priced like shoes and bread. Everything makes sense. Behavioral finance has chipped away at that for quite a bit of time. But from the very beginning, when Frost and I wrote our book in 1978, we said the financial markets are a psychological phenomenon.
Yeah.
And I'm a radical on the other side. Just as the efficient market people are here, I'm as far as you can get over here. Because I think all of the movements in the market are based on waves of social mood.
Yeah.
There are occasional short-term emotional reactions to news, but they're very transient and they're quickly over with, and the market reprices right where it would have been in the model anyway.
Yeah.
And that's a very different way of looking at things, but it's so useful because with that model, you can anticipate changes in the things that the efficient market guys think are pricing stocks, such as the fundamentals.
Right.
And now you're seeing tremendous changes in fundamentals. Remember how bad the earnings were at the bottom?
Yeah,
We had a negative quarter in the fourth quarter of 2008.
Yeah.
Actual losses for the first time on record. And then the market goes up for 2 years, and what do we have?
Yeah.
The best earnings ever.
Record earnings?
They follow the market. They do not lead.
Yeah.
And I would get on TV sometimes when an economist says, these earnings are terrific, you want to own stocks. I said, no, that's the opposite of the way you should think if you want to make money in the market.
Yeah. Well, it's something that when you look at it, it becomes apparent. But frankly, most people don't look at it.
It really doesn't. For some reason, people can look at that chart and it still doesn't sink in because they're so stuck in the billiard ball mechanical causality mode, which is that, well, nothing's going to change unless an event occurs.
Right.
And we say, look, we can predict the events because it's human beings changes. Human beings changes in their social mood that is causing them to take social actions that end up being events and showing up in the newspaper.
Yeah.
So if you wait for the event, you're too late.
Yeah,
the market's already down in immediate reaction to those changes in mood.
Right. So we're in this. We're going down in the wave. Where does it go from here? What's the time frame as it in the wave model?
Well, I tend to jump the gun. If anything, I can see the structure or at least I believe I can in the future. And so I get so excited about a change sometimes. Okay, we're coming into a low. This is going to be really exciting. And sometimes it takes a few more months to get there. Same thing at a top. It can take a lot longer than I ever thought. So I don't know if people should rely so much on time forecasts. It's going to happen when it happens, and it'll bottom when it bottoms. And I think we'll recognize the structure when we get there. However, because I can't help myself, I still do a lot of timing work. And from several different approaches, which I discussed on that video that you mentioned, I believe we've got about 5 down years to wash out the financial system and get to a good bottom. And let's bring up one more topic. What you're trying to do with your clients, and what I'm trying to do with people who listen to me, is protect their ability to buy. So that when the real low comes and the real bargains are there, they've got the wherewithal to do it.
Yeah, and that's the time you're going to want to have that cash. I mean, you're going to just
my God. Imagine buying a $50 stock that's selling at an eighth.
Yeah.
Or I guess they don't call them eighths anymore.
Yeah,
but you know what I mean? I mean, the kind of multiples you get when you're buying at a true bottom, like 1974, 1982, 1942. The first few years off the bottom, a lot of stocks go up 10 and 20 times. That's the real money. But if you ride it all the way down, you can't do that.
Yeah, exactly. Well, and again, this is just part of the strategy of divide your assets, take, get safe in most of them, and if you need that juice, if you need to play it, if you need to be in the market, well, take a bit of it and go play.
Oh, well, actually, that's the fun part. We track the market short term as well. In fact, we even have a guy who follows it intraday for people who are intraday traders. But our 3 times a week update is focusing on these changes short term, and with so much volatility recently, to us it's kind of a playground. To a lot of people, it drives them crazy. But if you catch a few swings up and down in 2 different directions, it's a lot of S&P points. So it all depends on what kind of person you are. Most people aren't traders, and I believe most people should not be traders. It's really 1 in 10,000 that's got the emotional makeup to learn how to do it well.
That's right.
So most people should avoid that. But I think if you take a position that's not overly leveraged, I think you can make some. That's where you get your interest. Instead of having that risky bond, why not just have a few futures contracts short the S&P, and if you want to make a little money, that's where it'll be.
Right, when most of your money is sitting.
Or commodities,
safe.
if you really are a glutton for volatility.
Right, exactly. So on the gold piece, because this is interesting, one of my clients called me and said he's got $1 million sitting in gold and silver right now, physical, and I just was like, I couldn't believe it, and that was most of his assets. It's just a commodity. I mean, it's just going to have that massive.
Well, gold is real money, and eventually it will. It won't go to zero like a stock can do.
No.
So he's got that going for him. The same people that got everyone caught up in silver in 1980 were bulling it up this time. It got almost to the same dollar amount. And of course, instead of what I try to do is I try to get less bullish as the market goes up, and more bearish thereafter once I turn bearish. As it goes down, I want to get less bearish. But people who are married to a position such as peak oil, or running out of oil, they can't think of any possible reversal.
That's right.
So the idea of oil going from $147 down to $34 in 5 months would never cross their mind, and that's exactly what happened. Same thing with precious metal people, especially the silver people. They say it's got to be $200 or $300 an ounce, and they can't imagine a 50% drop. And those, when you get into when you use those kinds of fundamentals, you're setting yourself up to get really hurt. Personally, I think gold is high, but I still advocate holding whatever gold you bought in earlier years. Now, if you're overly invested in it, then I would say you might want to diversify a little bit. I'm not a big fan of diversification, but at the same time, I think you shouldn't have every single egg in the same basket.
Good. So as we go, there's going to be some key frames, some key moments that I think, and forget timing, but just there's going to be some things that occur. Do you see any of those? In your mind, how you see those key frame moments in the coming years? Well,
yes. One of the things. See, people are going to want to blame the decline on bad news, and when we get into it, the second declining phase, which we're in, that's when bad news tend to just pour out. And people say that's the cause. But of course it's not, it's the result.
Yeah.
At the high, you didn't see any bad news really. All the news was great, record earnings and that sort of thing. And as we go lower, more and more bad news will come out. One of the results of a trend toward negative social mood is a polarization of groups, conflict among the groups. You can see there's already been blow-ups in the Middle East. They've actually changed governments over there.
Yeah.
They said, well, the United States is nice and calm, and all of a sudden, a few weeks ago, what happens? We've had demonstrations on Wall Street. Now they're marching all through Manhattan. It's popping up in other cities.
Yeah.
And when you ask them what they're angry about, they've got a few vague ideas, but really they're just angry.
They just want to express.
Exactly right. And that's what social mood is all about. Now,
Yeah.
some people express it randomly, kind of like that, protesting,
Yeah.
they're not sure what. And other people actually mobilize forces and express it more pointedly.
Yeah.
And that's how you get things such as separatist movements, riots, revolutions, and all those things that we think are likely to come during this wave as well. And by the bottom, you remember how afraid people were in the first quarter of 2009
Yeah.
to buy the stock
Oh,
market?
yeah.
And you can always look around and point out reasons.
Yeah.
We're going to have all those reasons at the ultimate low. Oh,
Yeah.
we don't want to touch stocks with a 10-foot pole. Only a crazy person would do that.
When you hear that, that's when you should buy.
That's when you want to start looking at it.
Yeah, exactly. So, well, I mean, this is so helpful. It's not the view you hear.
That's
And
for sure.
yeah, I mean, we've got this media that just seems to follow and promote this certain perspective. And my understanding of how we work as humans is we really get married to our beliefs, and it's very hard once you get married to any belief to get out of it. But the greatest challenge and the greatest reward lies in challenging your own beliefs.
And if your beliefs are substantially motivated by an unconscious social mood,
Right.
you don't know why you're expressing them really. And that's the kind of thing that I'm trying to explain, that social mood permeates all kinds of people's thinking, and then they'll come up with rationalizations,
Yeah.
not realizing that's what they are. They're calling them reasons
Yeah.
why they should own this particular item, not at $250 an ounce, but at $1,900 an ounce.
Yeah.
Why they should own this stock not at $20 a share, but $160 a share.
Right.
Why they should own oil not at $9 or $10 or $11 a barrel, but at $90 and $100 and $140 a barrel.
Yeah.
There are always great reasons to do the wrong thing. Where did those come from? They come from rationalization, and the rationalization is motivated by their mood. So no wonder people today are saying, as you said earlier, nothing bad can happen, everything will be fine. We're in a major top area.
Yeah.
And that's how people think at those times. And at bottoms, they think we'll never recover.
Yeah. Yeah. Yeah.
And we always do.
We always do, and somebody sent me an email the other day and said, because we were talking about the dollar, and I'm very bullish on the dollar because of what we just talked about. And he said, it seems like the top commentators don't agree with you. And I said, and that's exactly my point.
Exactly. Oh, look, the dollar, I would say, and I've been in this business since the 70s,
Yeah.
has been the most one-sided market I think I've ever seen.
Yeah.
Certainly on the downside.
Yes.
The amount of vitriol expressed toward the U.S. dollar in the past few years has been unbelievable. And incredibly, the dollar hasn't made a new low on its 2008 bottom.
Yeah.
And then it bottomed a few months ago and held above that low, all during the most amazing pummeling
Yeah.
verbally that I've ever heard. And you need to bet against it, you need to buy the foreign currencies, you need to buy all these commodities.
Yeah.
I think that's the wrong way to go here, and it's so one-sided. I could make a bet the dollar's going up on that basis alone.
Yeah.
And the recent bounce has attracted a few people, so we'll shake them out before going higher.
Yeah.
But you're absolutely right. You have to have the courage of your convictions as an individual,
Yeah.
and absolutely do not follow what the extreme consensus is. Sometimes consensus is right for a while,
Yeah.
and that has actually caused me some headaches over the years, particularly when historical extremes are being reached.
Yeah.
But you know what? If you stay out of a crazy market, you'll be happy a year or two later.
Right, and you'll have your money, and when that time comes, you'll have the money to get in there and have the true bottom and get incredible returns. One of the things I always say is, it's your money, act like it. And I'm surprised because people don't act like it. They're afraid to call their bond broker and sell because they don't want to offend him. I mean, I'm just shocked. Like, It's your money, man. Act like it. Take some sort of responsibility here.
That's true. And there's another psychological sort of quirk that I think is rather funny, and that is that people think their job is to buy stocks.
Yeah, right.
You know,
We've
or
been sold
buy
that
this
hard.
or buy that.
Yeah.
I own this. I want this. I want to buy so and so. But the point is to make money, right?
Yeah.
So that means your ultimate goal is the money.
Yeah. Yeah.
It's not just to amass stocks.
Yeah.
If you really love stocks, hey man, hold them. Who cares if they go down 50% or,
Right.
or 80%?
You love them.
You
That's
own
what
them.
your goal was.
Yeah.
Yeah.
On the other hand, I always tell people, if you really do love stocks, which I think at the bottom they will disavow,
Yeah.
you can buy plenty more of them if you hold your money now and wait.
Exactly. Exactly.
So,
Well, Bob, this has been fantastic. I really
it's been fun.
thank you for joining us, and this is something that I really hope that people listen to. I hope it opens their mind. I hope it makes them question. I hope it drives them to your website, and I'd love to give them access
well,
to
I
it.
appreciate your forum, because so many times, particularly in video interviews, you've got 120 seconds, and
Yeah.
it's hard to cover the gamut. But we did a pretty good job today.
We did a great job, and I'll be happy to come back up and do it again. And maybe in a year, when we see where this all goes, we can check in and
say where we were right and where we were wrong.
exactly. So,
All
all right.
Yep.
Thanks a lot.
Thanks.
Appreciate it. This has been The Mind of Money. Thanks for joining me, and I'll see you next time.